Welcome to the Big Mike Fund Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlatnik. Today it is my distinct pleasure and a privilege to welcome Rob Levy to the episode. Hi, Rob.
Hi, Mike.
Thank you so much for coming on the podcast. Appreciate your time and your wisdom in advance.
Yeah, thank you for having me. Really appreciate it.
Thank you, Rob. So could you tell us a little bit about you? I'll just tell the audience I've been working with you for quite a while. We've had great experience working together. We've invested in a number of your deals, and we certainly like the sector. Some people think of it as a going down sector. We think of it as a land of opportunity. It's a little bit of a contrarian play. The space is retail, and America is going through transformation in that sector. And you can take advantage of great pricing and market disbalance. And you're one of the specialists who likes this market in the Southeast. So tell us a little bit about Rob, where you live, your family, and how did you wind up jumping full speed ahead in the Southeast retail?
Sure. Well, again, thank you for having me. Really do appreciate it, and happy that we've done a number of deals together. It's been great partnership. I live in northern New Jersey, just outside of New York. I've been living here for about 20 years now, wife and 3 children, and commuted into Manhattan for many, many years. My previous stints in the real estate world. I've been in the real estate business for over 30 years now. I hate to admit it, but that's true. And in all different kind of facets of real estate, from asset management on the institutional side. I worked at Prudential in their real estate investment group for a number of years. I did investment banking, also in the real estate space, covering publicly traded real estate companies, and then I was a stock analyst, also, kind of writing reports and covering the publicly traded real estate and operating companies and investment trusts. And then for about 12 years, I was with a company called Centerline Capital Group, which was a multifamily finance and investment company, primarily multifamily. We did some other property types also. I was we were a publicly traded company. I was the CFO and then the CEO of Centerline, and then we sold that company in 2013, took it private. A large private equity group acquired the company and took it private. And then I did some private equity after that. But in 2016, broke away with my partner, Phil Block, and the two of us kind of were trying to think through where we thought the most interesting and best opportunities were in the real estate space. We have diverse backgrounds, I said, office, industrial, lodging, multifamily, certainly, and retail, and just felt that with all the dislocation going on in retail today, all the changes that were occurring, that could or should lead to some interesting opportunities to acquire real estate. And so for the past 3 years, since kind of the middle of 2016, we have been focusing on retail.
Gotcha. So there's certainly displacement in the market in the retail. And why do you think it's the right play? Is it because the prices are so good? The sector is viewed as a shrinking sector, with e-commerce and Amazon specifically taking a bigger and bigger share of the retail market. Why the good old shopping centers are still interesting, and why do they provide a great investment opportunity?
Well, I'd start by saying that Phil and I are kind of contrarian by nature. We, as I said, we have very diverse real estate backgrounds, and certainly in 2016, we sat down to kind of talk about where we're going to focus on, where we're going to invest, we spent a lot of time thinking about multifamily specifically, and then some other sectors, and we just felt that there's a significant imbalance today of sellers and buyers. The REITs are selling, other institutions are selling, and they're kind of selling what they consider their non-core assets. The REITs are being kind of forced sellers. I don't want to say forced, but they are active sellers because Wall Street is telling them that they need to raise capital to finance their development pipelines and to finance stock buybacks and things like that, and they can't raise capital in the public market. So the only way they're raising capital today is through selling their non-core assets, and that's exactly what we're focused on. We feel that they tend to own good real estate in good markets, but they're not the best operators in our view, and so there's an opportunity there. But to step back for a second, there's just a significant dislocation. We are in no way naive to what is going on in the retail world. Retail is changing drastically and is changing quickly, but in our view, it does not mean that all retail is going away. There's good retail and there's bad retail. Maybe there's more bad retail today than there was 10 years ago, but there still is some very good retail and very good real estate. And, we are focused specifically in the Southeast, from Virginia down to Florida. We like of course, the economic and demographic growth that's going down there. So we're focused on acquiring assets in growing secondary markets within the Southeast. So Charlotte, Atlanta, Charleston, Greenville, South Carolina, Orlando, Tampa, Nashville. That's where we own. And, in our submarkets, we're seeing population growth of 2, 3, 4% annually, businesses moving in, and we think that's very protective. So we just think that it's an oversold situation. That there certainly is a lot of dislocation going on in retail, but there's just more sellers than buyers. When we show up for a potential acquisition, we tend to see 3, 4, 5 bidders somewhere in there. If you go to bid on a multifamily property today, you're bidding against 25 or 30 buyers, and we just like that dynamic today.
Yeah, that's a very interesting perspective. There's certainly multifamily is trading at historically low cap rates, especially the cost of financing is cheap. And with the Fed reversing direction, it seems like there's a fresh wave of buyers in the multi-sector if they can pick up these assets, and there's certainly a lot more competition, and the prices they're paying much higher price for the future cash flows. And retail presents that opportunity. You could buy great cash flows. So let's talk a little bit about cap rates. So typically, what kind of cap rates are you able to get today in retail? You're generally buying Class B properties, non-core assets, secondary markets. So what kind of cap rates are you able to get, and what kind of leverage can you put on them, and what kind of cash flows?
Yeah, so as you said, we're buying kind of B plus, maybe A- properties, more discount oriented. We feel that part of the retail world is actually performing very well. And some supermarket anchored, some not. So, we have Publix and Kroger, we have Lowe's Foods, and the like. And then we have, exposure to, some of the TJ Maxx brands, TJX brands like TJ Maxx, Marshalls, Home Goods, et cetera. So, and then, kind of a lot of service oriented tenants around them. So more discount oriented, more service oriented, some food oriented, and then, a bunch of restaurants and nail salons, hair salons, doctors' offices, and things like that. And as I said, we're focused on kind of these higher growth markets in Nashville and Charlotte, et cetera. And so our cap rates today, it kind of depends. We're not really cap rate buyers. Obviously we look at it, but it's really more of, kind of a total return view. But our cap rates today are probably in the in the 8% range up through kind of, on average into the low nines. And we have done a couple of deals north of the 9.5 mark, and we've done one deal below 8. But that's just because really there's on the one that's below 8, because we just felt there was upside. We could push rents, we could bring in new tenants, and so at the end of the day, the cap rate that we're buying at, we felt was more like a 9 to a 10, as opposed to the kind of 7.5 or so that we bought the center at. So so we're seeing cap rates in the 8 to 9.25% range, and we're not high leverage guys, so we typically put in financing on our properties in the 60 to 65% range, and cost of debt today is, let's say, on average around 4.25%, and so we see some great cash on cash returns, and with some upside in the property.
Yeah, that makes a lot of sense. You certainly have a very sizable spread between the cap rate that you're paying, just even if that's pure entry-level cap rate versus the cost of financing. That spread is a pretty sizable upkick. It's hard to do in multifamily to have a 300, 400 basis point spread. You certainly have that in the retail. But what are the typical value adds? So I've certainly seen you selling out parcels. That seems to be one of the key value add strategies in the retail sector. You pick them up at 9 cap, 8.5, 9, that range. Let's just say that's your average cap rate before value add, and then you start executing value add. And can you talk a little bit about that, selling out parcels? What else you do to enhance the value of the shopping center and enhance the cash flows?
Sure. So before I go there, I just wanted to say one more thing about value. Most of the time, in fact, all the time, we are acquiring our assets at significantly below replacement cost, which is something we look at. I mean, it's not a critical number, but it does make us feel better when we're buying a shopping center at $100 a foot, and we know that if you add in the value of the land and the cost to develop, it's probably $175 a foot or $200 a foot, whatever it might be in that location. And in times like we acquired a center in Orlando, right next to or a mile down the road from the University of Central Florida, a great location, hard corner, great visibility, great traffic counts, etc. And that center we bought for $20 million approximately, and it's a 20-acre parcel, and land in that market is going for about $1 million an acre. So in our view, we basically acquired this center for just about land value, maybe slightly over land value at a 9 cap, and we're cash flowing to an 11% cash on cash return today. So from a value perspective, it's really interesting at times. We're basically buying for, significant reductions to replacement costs. But back to your question on value add, I mean, it depends. There's, a lot of times, as I said, we're buying from bigger institutions who we feel don't do all the small things that can be done to optimize value in these centers. So, there's lease up, there's pushing rents, there's bringing in better credit, and all those things that you would typically do normally in a shopping center. And then as you said, there's out parcels where we're buying a center at a 9, but you can spin off, an out parcel that has a Jimmy John's or a Starbucks or whatever it might be at a 6 cap or 6.5 cap, and you make the arbitrage. So we tend to put some capital into our properties. They tend to, they're good properties, they're good pieces of real estate, but they've been undermanaged. So we'll do roofs, we'll do parking lots, we'll put in new lighting, we'll do facades, and et cetera, and really kind of spruce things up. We've done some major renovations on a couple of our properties to really improve tenancy. So it's all those things, and which allows us to take it from kind of an immediate, call it a 10 or 11 or 12% cash on cash return to a mid upper teens total return IRR over the hold.
Yeah, I got you. Yeah, it makes a lot of sense. I mean, it sounds to me it's a land play from a downside protection. There's a value of the land. These shopping centers are located in good location in these second-tier MSAs, not New York, not San Francisco, though those obviously trade at a much different prices. So take Orlando. It's a still booming market. You got Universal Central Florida. You got obviously Disney World, Universal. That continues to do well. And I completely understand it. It is the value of the land on the downside, and on the upside, you got strong cash flow starting from low teens and then improving cash and cash into mid into high teens, which is very, very, very strong for folks who are looking for great cash flow. And on top of that, I'm sure you got all kinds of tax benefits, depreciation, accelerated depreciation. So it's a great income play, not really counting on any appreciation, but if it happens, that's great. So am I seeing it right? Is there any other strategic angles? The one thing that I wanted to comment, and it's not necessarily all that positive comment, but it's certainly an important comment, that yes, you're buying these properties below the construction cost, but the question is, if the land was there empty, would people build a shopping center there again? And that's the question. We see a lot of conversions, self-storage seems to be a common play and works pretty well in many markets. But the bottom line, with today e-commerce changing, it would appear that the trend is to build warehouses, not in the center of the city, but suburbs or outskirts, and then deliver the goods to folks ordering on the internet. How do malls, kind of fit into that? Is there a strategy where some of these shopping centers could be repurposed, or you're certainly focusing on service-oriented businesses? But is there any other thoughts on downside protection to give people confidence the sector ain't going away, that real estate is not falling apart? So what are your thoughts on that?
Yeah, no, it's a good question. I have a few things to say. First of all, because you use the word malls, I just want to be clear. We are not investing in regional malls, in enclosed malls. That business, that part of the retail world, is really drastically changing quickly, and it's just shopping habits have changed significantly, and also a lot of regional malls are not in optimal locations, right? They are on these ring roads, some of them, not all of them, some of them, the B's and the C's, not always, kind of in the best, most highly trafficked areas near where the demographic growth is. We are not buying those. We are buying neighborhood and community shopping centers in the communities, and typically our properties are in kind of premier locations. They are kind of main and main, good pieces of property, good pieces of real estate on highly trafficked roads, on strong intersections with good visibility around which the demographic and economic growth is occurring. And that's what we're focused on, because that, we believe, is defensive for our assets and our investors. So that kind of goes to the alternative use question, which on our properties, we don't own one property where we believe self-storage is an option. We just feel that that's kind of, if you bought a B or a C property off the beaten track in not a great location, that is, that type of alternative use could potentially work. But our assets are sitting on great roads, kind of strong locations with all the traffic around it, and that is not the optimal use. Now, I'm not saying that there couldn't be some alternative uses for our properties. So, for example, going back to that Orlando deal again, just because we were talking about it, so it's a good example. Because we're buying it at such an interesting value. Right behind our center, a huge new student housing development was opened about a year and a half ago. Next to us, there is a Burlington coat factory that's oversized. It's in like 90,000 or 100,000 square foot, and it's a bad piece of bad building. And so the largest student housing developer in the country is under contract to acquire that property, to develop it as a 600-bed student housing property. And Burlington is not leaving the market. They're actually just moving down the street into a better location, or a smaller box for them. So that property, we think, long term, it's a great piece of retail right now, and we're going to get it fully leased, and there's new restaurants coming in coffee shops. But who knows? Maybe 10, 15 years down the road, the highest and best use for that could be student housing because of University of Central Florida, how fast it's growing. So there is some alternative use that we think about, but our properties are, great pieces of real estate, and that's our focus. And today we feel the highest and best use is retail.
Yeah, Rob, I fully appreciate clarification. And I guess I misspoke. I'm an investor in a lot of your deals, and I certainly say not malls, but the shopping centers. That's a very different play. I agree with you. The dynamics are very different, and having heavy residential population or student housing or any other type of residential play in proximity is critical. I used to live in New York, and we have a lot of these small grocery stores everywhere. The reason is people don't want to go far. So in New York, due to the traffic, close proximity, plays a big role. And other parts of the country the same way. As population grows, the traffic gets worse, and people don't want to travel far. So that trend of getting in the car and being, or even walking over to the shopping area or experiential, restaurants, anything like that, is still out there. People still want to enjoy their life. They don't want to get everything delivered. Some things people still like to try out. So this is certainly, if you're ordering paper towels, if you're ordering, some of the non-perishables, you can order it on the internet and get it delivered. But fresh food, having a grocer and being local makes a big difference. It's just people enjoy. It's almost like we live in the 21st century, but we still want to hunt, and we still want to look for the food ourselves. We want to try and see what we buy. So,
well, I completely agree, and it's also hunting for the experience, right? It's like, using that term that you just used, like, so for example, if retail is going away, then why is it that companies like Ross are so profitable and so healthy? They're opening up hundreds of stores. Their profit margins are close to 15%, their EBITDA margins. Their sales are growing by 2, 3, 4% a year. So the reason why they're successful is because they're creating an experience for the shopper. I don't personally love that experience. I'm not a shopper at places like that. But you walk into a Ross store in a good location, and it's amazing what's going on. We just bought a Ross or a shopping center that has a Ross in it in North Charleston. And in the past year, their sales have gone from 11.9 million, which is a very strong number for them, to close to 13 million in a year. And so why is that happening? It's happening because it's good real estate, and there's a bunch of people moving in and businesses moving in around it. And also Ross does a great job. They're providing something that the internet can't provide. The experience of walking into a store and kind of, going out and finding all new things. It's kind of a hunting shopping experience. And that's why Ross and TJ Maxx and Marshalls and Home Goods and all those types of stores are performing so well today.
Yeah, the keyword is the shopping experience. People enjoying the shopping. They're not going to the store to just get stuff. They certainly, it's an exploratory trip. It's something that they find something cool, and that's why the stores do well. I mean, there's probably there's a reason why people do this. It's back to the IKEA. I don't know if you've ever been to IKEA. I like the same thing, and I haven't been to Ross, but I can tell you, you go there, you just never know what you're going to see, and it's almost like it's fun. It's a little bit of a shopping experience. Although I'm not a big shopping fan, but I think it's not going away. That's the bottom line, and you're picking it up at such a great price. The whole sector is trading at a discount. So it is a contrarian play. It does take some level of confidence to invest, but at the same time, the location, the value of the land, the cash flows, tax benefits of depreciation, it's a very attractive combination today. So Any other thoughts? I know you're driving this business aggressively. You're looking for more deals, and we're going to have another conversation shortly on your upcoming deal. And you keep finding these opportunities. And from my perspective as a fund manager, I have to say that I pick and choose my battles. I pick and choose best people that I like, know, and trust, who I like to invest with, and you guys are one of them. So for sure, I've had a good degree of success working with you, and I continue to do that. So, are you still seeing a lot of opportunities? Is there any future shift? Is there going to be any kind of, at some point, even these REITs, people will wake up and realize they're now trading at such a steep discount. Maybe we should start shifting some capital there, and the deal flow will tighten up. What do you think? Are you going to continue to find good deals? Is there any kind of projections of what's happening, for the rest of the 2019 into 2020? Any kind of view of the future of this sector and where it's going? And I know you underwrite your deals conservatively. You're not assuming any appreciation, but just in general, what do you see happening today, maybe into next year?
Yeah, I mean, right now our pipeline is very strong. There's a lot of deal flow. The REITs are still selling, and other institutions still selling, and then some locals are selling too, just because it's just kind of a good time for them to get some liquidity, I guess. So we are seeing a good deal flow now. A lot of it is kind of interesting. Everybody talks about, again, the retail apocalypse. What's interesting to us is 90% of the properties that we see are fully stabilized. They're 90+% occupied. There's really nothing to do there. There's no value add. And so, that we just, kind of pass on those deals because it's not our business plan. Our business model is to kind of focus on those deals where we can add value. From a capital perspective, we have seen some institutions coming into the sector a bit over the past 6 months. So there has been a little bit of new capital coming in, but what we focus on are deals kind of in the $10 million to call it $30 million range. And probably our average size deal is between 20 and 25 million. And what we like about that size of the sector is that it's too big for the local guys who, can tend to not always be the smartest buyers and sometimes bid deals up. So below 10 million, you sometimes see that. And then above 30 million, same thing with the large institutions. They have a lower cost of capital. They want a deal and they're willing to pay more, and therefore they're willing to, to pay a lower cap rate or, kind of higher valuation for that property. So we stay within this 10 to $30 million range, and really kind of between 15 and 25 is most of our deals. And what's great about that part of the sector is because you don't have the locals and you don't have the institutions, we tend to get better deals, and there's less capital in that area. So we've seen kind of capital coming in, but more of it is kind of in the $30+ million range, not in our, kind of in our range.
That's a good point. You have a niche. You certainly, let's just call it the lower part of the mid-market, which is sort of, still institutional level assets and institutional level ownership, maybe small institutional, but it's too big for most of the local guys. And you're right. It's funny how this subsector is driven by smaller entrepreneurial organizations. It's not necessarily exciting for big boys, and it's too big for small boys and girls, and that's why it's a land of opportunity. So I certainly appreciate that. Any other thoughts and wisdoms? We're kind of coming up on the time of the podcast. How will people find you? Is there a good website that they can get a hold of you if they're interested to take a look at some of your deals, potentially invest, and obviously they got to do their own due diligence, be comfortable with the sector. But I certainly like it, and there's a lot of people who ask. I've had conversations, say, listen, where can I park my money and get good income and tax benefits for depreciation? And probably your sector is one of the top sectors today to provide good cash flow with tax benefits. So anyway, how would people find you?
So the best way to find us is our website, lbxinvestments.com. And you'll see myself and my partner, Phil Block, on it, and our contact information. So you could always contact us directly. But we tried pretty hard on our website to put out some information. We put out monthly research on the industry, kind of things that we're seeing, whether it be trends or just a focus on a specific company or whatever it might be. Some research that we're seeing. We do, something I should have said before, we do subscribe to a bunch of research around retail. There's one group called Credit Intel, as an example, that is kind of a sell-side research shop specifically around retail companies. And so we get a lot of information on credit around retail, and we'll publish some of that on our website, or we'll put on our website. So our website is probably a good place to go. You can then sign up through our website for our investor portal if you have an interest. And then through the investor portal, you would see us whenever we announce any new transaction that we're bringing to market, just, if you're interested in taking a look. And if you have any questions about that, you can reach out to any of us. Heath Binder also runs our investor relations group and is always available to answer any questions.
Yeah, I can certainly attest for you guys' responsiveness, and I've had a great time reaching out with you and getting feedback, and we've been working for a while, and so I greatly appreciate your
responsiveness and trying your best to communicate fast, and yeah.
So that's been great. Rob, thank you very much. I greatly appreciate your time and your wisdom. We'll continue working together, and I enjoy very much your thoughts here. So thank you kindly for coming on the podcast.
Well, I appreciate you having me, Mike, and you guys have been great and supportive of us, and look forward to speaking to those who are listening to this podcast. And if you have any questions, we'd love to learn more about LBX and what we do, please just reach out to us.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.